We have seen about liquidity risk. Okay. Now please remember that when you have low liquidity, it means you have high liquidity risk. Okay. That means risk is more. Okay. We have seen that liquidity risk is the bid ask spread. Okay. You can say that if you want to sell the bond, you will not be able to get a good price, or if you want to sell a large quantity, the price can be depressed. Okay. So that is a liquidity risk which we see in practice. Okay. But you can say that I want to invest in a bond and I want to keep it for till maturity. Why I am, if whether I am exposed to liquidity risk? Okay. Yes, you are exposed to liquidity risk, because as an institutional investor, okay, you have to value your portfolio. You have to give a performance measure to your clients. Okay. So what you have to do is you have to mark to market the price of the portfolio. That is, what is the value of the portfolio given that today is this market price is this. Okay. So you have to value your portfolio. Even though you are planning to hold the bond till maturity, you have to value the portfolio every day. So since due to low liquidity, the price can be very different than the fair value. It can be lesser. What would happen is the return that you are giving to your investor, it would be less than what actually it should be. Okay. So this is the impact of liquidity risk on the performance. Okay. And secondly, we saw that in repo, the bond, the institutions, they are giving the repo as collaterals. Okay. Even in short sales, you can give the bonds as collaterals. Okay. Usually what happens is when the bond given as collaterals have low liquidity, due to mark to market, their price will be lower. The borrower, the security lender, or the person who has given you the money will ask for more collateral, that is more bond. Okay. So that means you will have to post more collateral. So even though you are investing bond till maturity, you are still exposed to what is called as liquidity risk. Okay. Now we'll see what are the other kind of the risk. Okay. So we saw that exchange rate risk. If you are investing in foreign bonds, okay, the amount that you are getting will be less than you actually want. So let's take an example. So let's take a scenario when $1 is worth 40 and a situation when $1 is worth 50. Okay. So suppose foreign investor had invested some money in India. Okay. So he invested $100. Okay. He bought a bond worth $100. So this $100 will imply that he has invested 5,000 rupee in India and he got one bond. Okay. And the rate in India is currently 12%. So he will get 6,000 rupee after 1 year. Actually, it is a reverse case. So if an investor has invested $100 at let's say the price of 40, he would be investing 4,000 rupee in India. Okay. Now let's say the interest rate that is being given. So let's say the interest rate that is being given is 12.5%. So after 1 year, he should get 5,000 rupees from India. Okay. So his return in dollar terms should have been 12.5%, or he should get back $100, $112.5. Ignore this. Okay. But when he goes and he exchange this 5,000, the exchange rate has become 50 now. Okay. So exchange rate has become 50, and after exchanging he is getting only $100. Okay. So what is happening is he invested $100 and even after 1 year he is getting back only $100. Okay. Even though the interest rate was 12.5%. Why? Because of the exchange rate risk. The exchange rate has changed, or the foreign currency has appreciated. Here like foreign currency has depreciated. Okay, sorry. So wherever you have invested, it is depreciated. So you are taking lesser money. So this is the exchange rate risk. Okay. Inflation risk, as we know that if the bond is giving you 5% return and inflation is around 10% now, okay, you are exposed to inflation, because at that time when you had invested, inflation was, let's say, 3% only. Now inflation has become 10%. You are getting a negative return. 5 minus 10 in terms of real return becomes negative 5%. Okay. Next is the volatility risk. Okay. Volatility risk is there in the bonds with embedded option. Okay. So we saw that diagram. Price of a callable bond was equal to price of a straight bond. So what, this is the straight bond and the callable bond price is this. So the difference was this call option value. So straight bond value is equal to callable plus call option value, or I can say that callable bond price is straight minus this, as this is the option value minus the call option value. Now you will see in derivatives that this option value, they increase due to increase in volatility. So they increase when the volatility increases. What happens is, due to increase in volatility, this will increase. As a result, the price of callable bond will reduce. Okay. So that will impact the price of callable bond, and that is a risk. Okay. Similarly, price of a putable bond. Okay, I will draw this time putable bond. Okay, so this is an option. Okay. So this is an option free bond. Okay, now you can have a putable bond which will have, like, you can put at a lower, at a price, right? So the difference between this, so this is a putable bond, blue one. Okay, this is a straight bond, and you add on that a put option value. Okay, so you are getting a higher price than what is the actual market price, so it will not fall below this. So due to volatility, again this value will increase. As a result, due to volatility, price of a putable bond will increase. So if you have invested in a putable bond, increase in volatility will make you happy, because the price of your bond will be more. Okay. Now we come to the last risk, that is the event risk. Okay, we have seen that some of the risks which are like outside the purview of or the control of the management can impact the bond prices. That is like event risk is like disaster, right? So a disaster can happen and it may ruin an entire company. So what will happen is the bond prices will fall because the assets are not there. Okay. Similarly, companies can go in for corporate restructuring. Okay. Restructuring of the firm, that means either selling of some unit or buying some other company. It impacts the cash flow. It impacts the debt ratio. Okay. So when a company has bought another firm, okay, using leverage buyout, that is by issuing more debt. Okay. Now since there are more debt, the company's risk has increased. So what will happen is the bond price should fall, because nobody wants to invest in a risky company. Okay, so they want more return. So a company can be company's bond can be downgraded by the rating agencies. Okay. Similarly, if there was a business which were doing really well, was generating lots of cash for the company, but the company has decided to spin off. Spin off means separate that division from the company and treat that as a separate company. So what will happen is the bond holders who were thinking that they will get cash from that business are not able to get that. So as a result, what will happen is it will impact the debt prices. Okay. Some things like outside the hand of the management are regulation. Okay. Some regulations can impact the bond prices, right? Like one regulation can be that if you see the case of British Petroleum now, they have spilled the oil in Gulf of Mexico. Now what is happening is the government, US government is asking them to pay around $20 billion. So what is happening is this will result in the cash flow of the firm, cash outflow. They are selling some asset, etc. So people who have invested in their bond should be worried, because it might happen that the company may not have much cash for payment to the bondholders. Okay? So this can impact the bond prices. Okay? Also, uh, there can be some regulation that all the pension funds should invest in only triple A rated security. They cannot invest in double A rated security. In that case, what will happen is, if they were holding double A rated security, they will sell. And when most of the firms are selling this security, the price will decrease, and hence there will they will not be getting the fair value of those assets. Okay, so this is also another risk. Okay, so we have covered reading 61 of the session 15. This was a session which was interested in finding out what are the risks which a bond investor is exposed to. This was a very important reading. Please be thorough with the impact on the of the coupon, maturity, etc. on the bond duration, as well as on the reinvestment risk. Okay. Thanks a lot.